How do the rich pay no taxes and yet they're worth hundreds of billions? Well, I kind of want to talk in a bit of a fun video today. It's kind of a random ramble / kind of explaining a concept, because I want to demystify an entire financial and kind of corporate concept that most people don't realize, and until a few years ago I didn't know anything about. And it truly is it kind of brings together the whole kind of reality behind the rules are written for the rich, and finance is the language of the elite, so to speak, if you're going to kind of think that way about it. And not to go down the kind of conspiratorial route of it, but the whole thesis behind this idea that, the media and certainly society is kind of made to paint the wealthy or the rich in a mainly corrupt, immoral, unethical way, as it's promoted in the media. Basically, you'll never really ever see a wealthy person or a rich person in the media painted in a positive way. If they are painted in a positive way, it's because they're a charitable person or they're so-called philanthropic or whatever it might be. So I want to break down a few things I learned a few years ago that I love still going back to today, because you can truly never really fully master these ideas. But one of them was from a book called Rich Dad Poor Dad, which kind of talked all about assets and liabilities. And this is kind of the fundamental thing that I learned a couple of years ago now. Well, a few years ago now, like at the end of 2020, beginning of 2020. Liabilities, if I can spell the word. These two terms I learned a lot about the kind of beginning to midway through 2021. These terms are brand new to me, and if they're brand new to you now, I kind of want to go through them. So basically, to make sense of it, you may have heard the term assets before. If you basically have heard of the word trust, or if you've heard the word corporate or company, you may have heard these terms before in different kind of contexts. But the way to understand them, or the way I've understood them going through this route of understanding them, is that an asset is anything that provides you with a net gain. So it has value. Normally it's growing in value because it's like a commodity. Maybe you own, let's say you have some gold, whether it's you just have like shares in a gold stock exchange, or you physically own some gold or silver maybe. That is an asset, right? You can also own a company or stocks maybe. You might own a company or shares. That is an asset as well. You might own a car that is a rare car. So you might own a rare car that is a collectible. So that is going up in value consistently. So that collectible. I can't remember how to spell collectible. Terrible. See, I understand all of a sudden how to spell collectible. There you go. But yeah, there's various different things, and ultimately an asset just means it's something that holds its value, if not it's going up in value. So that's basically what an asset is. And a liability basically just means it's a net loss. So it's something that it doesn't normally hold its money, and it costs you to own it, basically. And it has no gain to it. So this could be your house, so your home. It could be your car. Again, they can be the similar things as well. I'll get onto the next bit in a minute about that. But your home, your car, anything else, even a failing business, it can be something. Oh, if I can spell failing, there you go. That kind of goes more into the next bit I'm going to go on about. But ultimately, an asset versus a liability. An asset is something that is a net gain. A liability is a net loss. So ultimately, that is what they are fundamentally. But I want to go into now how you can convert one into the other. The reason I want to start with this is because I want to go on to how these can apply to various areas of your life, whether it's personal life, business life, creating and growing wealth, whatever it might be. So let's say hypothetically you have your house. Let's just draw a terrible house to begin with. So you have your house, and you got some bloody windows and terrible stuff going on in the episode. There you go, there's the house. So your house is, let's say, 200,000, and you have let's say you're paying a mortgage of 800 a month for it, right? Hypothetically, it's kind of a lot for a 200 grand house, but hypothetically, let's say £800 a month mortgage payment, right? So at the moment, this is actually a liability. Although most people will see that as an asset, they have an asset, this is growing in value by, I don't know, 6% a year. It's going to be, you know, what's 6% of 20? It's gone up. I can't think of 6% off the top of my head like that. I could work it out in a couple of minutes, maybe like 10, 20 seconds. But either way, at the moment, it's a liability because it costs you to own it, even if it's going up in value, because you're not making physical cash into your bank every year. It's going up in value unless you do like cash out, you know, refinance it and cash out the refinance value. Either way, it's a liability because it's costing you that 800, this is a terrible pen around, it's costing you that much to own it, right? Every month, the mortgage payments. So, how do you convert this house into an asset so it can remain on this side? Well, what you could do simply is work out a way to at least make it break even so that the cost of owning it, the 800 a month for the mortgage payment, is covered by some form of payment. Obviously, the first thing is your job itself. Now, the first thing you could do to actually make the house pay for itself is rent a room out. So, you know, let's say rent a room. This pen is going to really keep screwing me over, so I'm going to change pen for a minute. So let's say, you know, you rent a room out for, you can Airbnb a room. So Airbnb a room for, let's say, 150 a night. And then 15, 30, 40, 60, 75. So yeah, let's say after, you know, you only have to rent it out 6 nights a month, and you've got your 800 there, sorted, done. That way, you're breaking even on your house. You basically, with any liability that costs you money, turn it into a business. Because a business is ultimately, you know, revenue, your turnover minus costs, and then whatever you break even with. So you'd actually be profiting like 50 to 100 or so per night, or for the month after your Airbnb there, renting a room out. So ultimately, the way to look at any liability you have in your life, whether it's a house where you can rent a room out or rent the loft of conversion, whatever you have, if it costs you to own it, it's a liability. If you make profit from owning it, it's an asset. So that's ultimately what that is in that situation, and that can apply to your car, your house, your anything you own really. And you know, if you can, let's say you could turn your like if you could turn your guitar or piano into an asset by just kind of doing piano lessons or something, or guitar lessons, and then, you know, you make up the cost. Obviously, that's more like you have one payment at the beginning. But either way, that's the difference between an asset and a liability. Is an asset is a net gain, a liability is a net loss, unless you start making money from the thing, from the cost. And that's how an asset can become a liability, and a liability can become an asset when you start losing money or gaining money from them. When you make them into a business and they're either making or losing money for you, can hit on the draw. So the next thing really is the first question I asked is how the rich use assets and liabilities to basically pay no taxes. They don't specifically use that, but this is how you can, you know, let's say they'll pay 0 tax. Oh my god, these pens. They'll pay 0 tax, right? 0 tax on their money, and they could be worth 100 billion, 50 billion, whatever it might be. So the first thing to understand is that in the book Rich Dad Poor Dad, Robert Kiyosaki says that the rich, that's terrible spacing there, the rich don't work for money. Now what he meant by that is that the rich don't really pay themselves a salary. Some of them might, you know, I think Jeff Bezos said he pays himself like 85,000 a year or something, but when he was CEO of Amazon, but most of these multi-millionaire, multi-billionaire CEOs and owners of companies that have millions and millions and millions of shares and they're worth billions, they don't pay themselves a salary. Like, I think it was quite famously said that Zuckerberg paid himself like a $1 a year salary. So how do they then earn money? So they don't have a salary, they don't have any income, they don't have any taxable income, so how are they making money? So what they do is, let's use, I don't know, Elon Musk as an example here. So let's say he's worth 200 billion. That is because of his shares in all of his companies, like mainly, you know, you've got X, you've got Tesla, SpaceX, etc., right? Although it's probably going to mainly be Tesla in these examples. So he has a net worth of 200 billion because of his shares in his companies he owns, the minority shares he has. Well, actually majority, but still, it's like less than 10% or less than 20%. So how does he survive? How does he pay his bills? How does he live and not pay any taxes? So what he does is, all of this will most likely, all of his assets, everything he owns will most likely be in a trust. Maybe not necessarily Elon Musk in this case, but most of them will have a trust which holds all of their assets. And the assets in the trust are probably in some sort of tax haven or jurisdiction anyway. And there's like, you've probably heard of the Panama Papers and the Pandora Papers, where all the billionaires and the rich people around the world were basically having all their money or having all their assets that they own inside of a trust, so that technically the rich and the wealthy around the world don't actually own their assets. For instance, if I show you, like, let's say if Jeff Bezos, for instance, might own shares of Amazon, but actually he might not, because Jeff Bezos, he might get paid from his trust, and his trust will have his Amazon shares, and Amazon shares are coming probably from Amazon's trust. If they have a trust, I'm not actually that sure, but either way, they'll be coming from Amazon, so it will look like this basically. So Amazon will be worth like 1.5 trillion, whatever, and then his shares, however many, like 100 billion of his shares will go to his trust, and then therefore Jeff Bezos doesn't actually own anything. And that is ultimately how the first level of how the rich don't own anything. The rich can't be taxed. You know, you can't seize any of their things, because by definition Jeff Bezos is just Jeff Bezos. He's the beneficiary of a trust, but he doesn't actually own anything. He's a beneficiary of a trust that owns things, but he doesn't himself. And this is how anyone, not just the elites, but this is how the elites, the rich, the wealthy get around this stuff and pay no taxes and things, because all their stuff is in trusts. And this is ultimately why people need to understand this, so that they can use this for themselves, because it's not like it's just a game for the rich. Like, trusts literally cost less than like a wedding. You know, you can set up a trust for barely like 1,000 or 2,000. Yes, it's a lot of money, but it's like a one-time setup fee, and most countries around the world only have very, very, very low, if any, like recurring annual fees. And ultimately, it's the cost of like the freedom of like having the freedom of over control of your assets and all that type of stuff, like the freedom to put your house in a thing so the government can't take it, all that sort of stuff. So how does someone like Jeff Bezos in this case, let's say, pay no taxes? So hypothetically, if he didn't have an income, if his trust, let's say, if he has 100 and let's say 100 billion hypothetically in a trust from his Amazon shares, right? So what he can do is he can go to a bank, or the trust can go to a bank, even better, and get a loan for, let's say just $1 million, even just $1 million, right? A loan against the 100 billion. And because it's tiny, like 1 million compared to 100 billion is a minuscule percentage of it, the bank will go, okay, you can take a loan for $1 million against your 100 billion, we'll give you that at 5% or something crazy low, whatever it might be. So he's obviously paying like, what, 50k in interest on that loan, or the trust is, either whether he takes the loan personally or the trust does, either way. It's $1 million loan, so he's paying $50,000 dollars to be able to live tax-free from 1 million. And obviously, it might be an interest-only loan. If he's got 1 million, he has a loan every year for 1 million, maybe refinance it every year, every couple of years, live off the loan, and the cost of that is literally just a 50k in interest. Now, it seems like a lot in interest, but don't forget, if you want to live off 1 million for 18 months or 2 years, that's, 1 million over a year, that's just under 100k a month, so 50k over those months is nothing. You're probably paying like a few rand a month in interest, and you're paying 5% of your entire amount over the cost of it. It's basically a 5% tax on your money in essence. So that's way less than any tax around the world, which is again why most of the wealthy will choose to get a very low, sometimes less than 5%, sometimes 3 or 2%, interest on their thing. And in essence, if they want to live in a place where the tax is higher than a few percent, 5, 10, 20, 30, 40, 50 maybe, or the effective tax rate can be sometimes even 50 or 60%, that's why they'll choose to get a loan, because it just is easier. So I hope that rambling of everything like that makes sense. I realize I've been talking for ages just about those two things, but I just kind of wanted to show how they do it basically, and the fact that, if they're worth that 100 billion, they'll live off maybe say 10 million for a couple of years, and they'll pay, in that case, 500k in interest, but they're making I don't know, that might be 300k a month, and it costs them, I don't know, 20k a month to be able to have that. So they'll just consider it like a tax, a small tax they have that's much less than the regular income tax wherever they live, to have the loan. And of course, they're not losing that value. It's a loan against that. So they've taken a loan for 10 million. It's cost them if they've taken a loan for 10 million, it's cost them 500k maybe. But in that time, this has maybe grown by 20 billion or 5 billion or however many. So actually, it's not even a tax in the end. It's just you've made money on the cost. And it's just a crazy way that the financial system works. But it's a crazy way. Oh, this doesn't fall over. It's a crazy way that the wealthy play the game of it. And it's a crazy way that you can play the game, because literally tax, trusts seem like, trust structures, corporate structures, tax advices, all seems like this game made for the rich. But the everyday person is, everyday people can do this. People can do this, and it is very possible for people. It just costs a little bit, but again, we have the world at our fingertips with the internet and social media as you're watching this right now, so it's more than possible. People, there are literally teenagers on self-help communities making tens of thousands, if not hundreds of thousands per month from a laptop, from their phone. And there's no reason you can't do it too. And there's no reason, even if you don't want to do that, it's still such low barrier to entry now to be able to do all these things because of the internet, because of social media. So yeah, just a little random ramble about trust structures and how the rich pay no taxes. So I hope you've enjoyed this random ramble, and I look forward to seeing you in the next video. Thanks for watching. See you next one. Bye bye.